everyone hear me? Cool. Well, we are so excited for you guys to join us this week. We are going to be talking all about mortgage pricing today. So we're super excited. Our last webinar was a great success. And something that was really cool from that was we polled you guys to see what content you wanted to hear about next. And overwhelmingly, everyone wanted to learn more about mortgage pricing. So we're super excited to share this with you today. Again, Mark Gordon, he is the National Sales Director here at Princeton Mortgage. And he's going to be sharing with us and speaking. He's super excited about this content. We're super excited about it. We're going to try to make it as interactive as possible. So if you can, I will be transitioning everyone from being a attendee, a panelist, so that you can turn on your video. If you have questions, feel free to unmute yourself, and we'd love to make this as engaging as possible. So again, thank you guys so much for being here. We're excited to share this with you today. And with that, I'd like to turn it over to Mark, and he is going to kick us off today. So take it away, Mark.
Thanks so much, Courtney. That was awesome. I appreciate it. So guys, yeah, do me a favor. You know, I haven't had a haircut in about 8 weeks. If I can throw my camera on, I'm sure you guys can do it as well. And we'll get really comfortable getting to know each other a little bit. It's always more fun for me if I can see you guys. I'm going to share my screen here in a minute. We're going to talk about mortgage pricing today. I'm going to go in depth with this as much as I can without losing people. And what I mean by that is it's a pretty complicated topic at the essence of it. But I also want to show you guys kind of some of the behind the scenes stuff that most of the even loan officers that I talk to don't really get to see. This is kind of something that, you know, most mortgage companies keep pretty close to the vest, like the secret behind how we do pricing and how we price out our loans. And so I'm going to expose all of that for you. And if I'm going too fast, or if you lose me at any point, do me a favor, just write in the chat window, shout something out, and that way I can go back. And if I'm going too fast for you, I'm probably going too fast for everybody. It's one of my major issues is that I tend to go too fast all the time. So I appreciate you guys, you know, giving me some feedback there and slowing me down if needed. So I'm going to go ahead and share my screen now. So let me just, perfect. I just want to make sure I can still be set up to see everybody.
I'm still turning everyone on, so the list will keep growing.
They'll trickle in. Awesome.
Yeah.
Well, thank you. So you guys can all see my screen?
Yep.
Perfect. All right,
yeah.
Cool. So that's me, how pricing works. So here at the core of mortgage pricing, we have these, well, what we're going to cover today is how mortgage pricing works, what determines pricing, how pricing varies by loan type and product, and we're going to also kind of describe some pricing terminology to you. We have some definitions here at the end that you guys can go over together, and we'll send out the presentation at the end for everybody. So if there's anything you want to follow back up on or see, we have all of the charts that we use actually in the presentation. I'm not going to spend a ton of time going over them here, but the actual charts themselves, I'm going to use more of our interactive pricing tool, but I will go over them with you kind of on a high level, and then you can always go back and check this stuff out later. So at the core, the biggest factors that influence mortgage pricing are credit score, which most people already know, assets to a lesser degree, but for certain products and certain situations, it can make a really big difference. Loan to value, or LTV, which is the amount on a purchase, the amount of money people are putting down, or on a refinance, the amount of equity they have in the home based on the current market appraised value. And then loan purpose. And loan purpose, more than you would think, particularly in today's environment, is a huge factor in pricing. What you would get on pricing for a purchase loan versus a rate and term refinance versus a cash out refinance can vary wildly, particularly when coupled with these other factors. So all these things interact together. It's not just one linear form from one side to the other in terms of pricing. Each of these things interacts differently in each of those loan scenarios. And that's why most people don't even get into the explaining of this stuff and really have a hard time. It kind of is the secret sauce, right? But we're going to kind of uncover all of that for you guys and really expose it all. And again, for you guys who just trickled in, if you wouldn't mind and you're open to it, throw your camera on, but if not, I understand. So here's just kind of a basic before we had these pricing engines, this is kind of what we used to do in the mortgage industry as our basic starter mortgage chart. And I want to talk to you guys about risk. And this chart in particular tells us a lot about how mortgage companies view risk. Now, this chart is direct from Fannie Mae and Freddie Mac. So this is not some investor overlay chart or one individual company or Princeton mortgages chart. This is just how the government has decided to price risk. And by the way, this has changed over the years as well. And we'll talk about that in a minute, how they price risk. So let's talk about just very basically where we stand. So this is for a purchase transaction, right? In this scenario here, with a term greater than 15 years. And you're going to see that this actually ends up being a big part of the equation. So 30-year mortgages, 25-year mortgages, 20-year mortgages, all factor into this price group here. Everything changes if you do a 10 or a 15-year mortgage, and I'll talk more about that in a minute. But what the government is basically saying is we view people who volunteer to do a 15-year mortgage or less as very different in terms of risk than those who are doing a 20, 25, or 30-year. What they're basically saying is if you opt into a 15-year, getting a little bit of feedback I think from Florence, if you can mute for me. Oh, there we go. If you do opt into a 15-year, the government's basically saying you probably will not default. At worst, you would refinance if you needed to save money. But if you're opting into that 15-year loan, we think you're less likely to default. So all of these pricing adjustments we're going to talk about here in a minute, if you were to do a 15-year program, would not apply to you. So in other words, you could have 620 credit score and be at 95 LTV, which is the riskiest category on the chart. But if you do a 15-year, you'll get the same pricing you would with a 760 credit score and a 620 credit score. So this is something to keep in mind. So if somebody for some reason has bad credit but can afford a higher monthly payment, a 15-year program might be the right way to go for them because we price that risk very differently. We no longer take a look at LTV or credit score on a 15-year program. We give people the best possible pricing on their 15-year deals. So something that probably a lot of people don't know or have never been told. So as you can see here, this is our least risky portion of the chart. What we're saying is if you put 40% down on your loan or more, and you have a credit score over 740, your application is considered perfect. Simple as that. There's no extra hits to your pricing. And we're going to talk about start rate pricing. I'm going to show all this to you really in depth, but I just want to I'm using this chart to kind of show how we evaluate risk. For every tick up we have in loan to value, your loan becomes riskier. And the reason for that is because in the event of a foreclosure, we'd be less likely as a mortgage company to get all of our money back. Pretty simple. You're also less likely to get foreclosed on if you have lower equity, because what's your option besides foreclosure? Selling the house, right? So if I'm at 60 LTV, I'm not going to go into foreclosure. If I need money, I'm going to sell my house, right? At 90 LTV, I might not be able to sell my house, and then foreclosure becomes more risky. Okay, so we're evaluating risk here. We know that the less equity you have or the more the value you're borrowing, the riskier your loan gets. Now, one thing you'll see right here is that's sort of true, except for if you notice here, as we go from 75 to 80 LTV, between 80 and 85 LTV, our risk pricing drops. The reason for this is once we get over 80 LTV, we have mortgage insurance. So that mortgage insurance allows me as the mortgage company to feel better about my investment and getting my money back. So while it's more risky overall to be at 80 to 85 LTV than 75 to 80 LTV, it's less risky for me as a mortgage company because that mortgage insurance company doesn't actually insure the borrower at all. It insures the mortgage company. In the event of a foreclosure, they give us the money back that we're out. So that's so as you can see, it's always very linearly risky from 60 to 80. And then sometimes you see different risk factors, especially at higher credit scores, based on mortgage insurance being over 80%. Everybody with me so far? Okay.
Yeah.
So also, each 20 points on credit score is also evaluated with a different level of risk. Now, what you'll see here is that down to a 660 credit score, we're basically saying it's pretty low risk if you have 40% equity. If you can put 40% down, you're not going to foreclose. You'll sell your house in an emergency. We're not really that worried about you. And even all the way down to 620 or less, we have a half a point of extra risk built in. Now let's talk about what a half a point means. On a $100,000 loan, this would be an extra $500 in costs that you would have to pay to get the same rate. So if your credit score is 620 to 639 and you're putting 40% down and borrowing $100,000, you would have to pay $500 more in closing costs to get the same rate as somebody with a 740 score or a 660 score. That's where that half a point comes in. Everybody with me so far? You can stop me if we're not. All right, cool. So as you can see, by the way, this is a matrix. So as LTVs get higher and credit scores get lower, it's more risk, right? So in other words, if I'm going to lend to somebody, let's say at 80% loan to value with a 620 credit score, I'm evaluating this as 2.5 points or $2,500 per 100,000 borrowed than somebody with a 740 credit score borrowing 80% of what their house is worth. And so that all makes sense. The part of this that may not make sense offhand, and it's built in this way because people I think just don't know about it, is that again, if you can go to a 15-year loan, none of this matters. So again, for your borrowers that for some reason may have a credit issue, but do have a bunch of income, it might make sense for them to go with a 15-year program because not only are 15-year start rates lower than 30-year start rates, but credit and loan to value are no longer an issue. You get the same rate on a 15-year if you have a 740 credit score at 60 LTV or a 620 credit score at 95 LTV. Now, there's mortgage insurance and other things over 80 LTV, but that's kind of a hack in the system if someone can afford a 15-year payment. Now, you may be thinking to yourself, how much more expensive is a 15-year payment than a 30-year payment? And we will go into it and talk about it, but it's much less than you think. It's not like you have to pay double to go from 30 years to 15 years. It's often about 25 or 30% higher, your overall principal and interest monthly payment, to go from 30 years to 15 years, and I'll show you that as we work up some other scenarios in our pricing engine. Any other questions about this chart that you see here? So as you can see here, most of it makes sense, right? If you were going to lend somebody money and you wanted a guarantee on your money, you'd feel a whole lot more comfortable lending to somebody with perfect credit and having an asset that has a bunch of equity in it, as opposed to lending to somebody with really bad credit where there's less equity. And it's as simple as that, right? So this part of what we do here really makes sense. Now, additionally, and there's a bunch of, this is something you might be reading about over the next couple of days. If you're doing a cash out rate, if a cash out refinance, there is an extra layer of pricing hits that you will get as a borrower. So if you're doing a purchase loan or a rate and term refinance, this is the only chart you're really worried about in terms of those risks. When you're doing this cash out refinance, you're adding this to whatever risk already existed on the other chart. Okay? So let me explain what that means. If you're doing a cash out refinance, even if you're in a perfect situation, you're going to pay $375 per 100,000 borrowed, more than somebody who has a rate and term loan or a purchase loan. And you can see here with 740 credit, if you're up to 80 LTV, which is where we cap cash out, you're paying $875 in costs per 100,000 borrowed. You're doing a cash out loan versus a rate and term refinance or a purchase. So what we're saying is people who are taking equity out of their homes by statistics are inherently more risky than people who are just trying to lower their monthly payment or are just purchasing a home. Does that make sense, yes or no? Obviously, the people who are smarter than me and are the actuaries who do this stuff say that these are the decisions that we're making and they put a whole lot of thought into it. I don't know, that's been my personal experience, but I'm gonna bet that they know what they're talking about. And you can see here, this is also credit risk based. So here's the thing, if you're trying to do a cash out refinance on a conventional loan and your credit score is 620 to 639, there's $3,125 in hits for cash out for every 100,000 you borrow. And then there's an additional, as you can see here, $3,250 in hits for every 100,000 borrowed just for the credit score and the loan to value. So if you add those two together, you're talking about $6,375 in additional cost for every 100,000 borrowed for somebody who has a perfect credit score on a cash out versus somebody who has a bad credit score on a cash out refinance to 80 LTV. Or I should say versus rate and term 80 LTV versus cash out with bad credit. So you can see here, this is how these risk factors are layered into the pricing. And this is how this works. Who feels like they're with me so far?
Hey, Mark, we had a question from Carla. She
Sure.
said, would it cost less to obtain an equity loan?
So in some cases it might, but here's what I'll tell you traditionally, and especially right now, but even traditionally, you have to have pretty good credit to get a line of credit to begin with. So in most of the scenarios here where you would be able to get a home equity line of credit, your hits are pretty minimized to begin with because you probably have 700, 720 credit scores just to qualify for that, especially at some of these higher loan to values. So there are times where that is the case. Particularly that's true, by the way, if mortgage rates are higher, but the rates where people are borrowing a home equity line of credits, which are attached to prime, which is the rate that banks lend money to each other and that's set by the federal government, if that's particularly low at a certain time and mortgage rates are higher, it can make more sense. Right now, both of those things are at all-time lows. So line of credits are being factored off of prime, which is set between 0.25% right now, which you heard the Fed funds rate, that's what we talk about. That's 0.25%. So line of credits are really cheap right now, but they're a little bit harder to get than regular loans. And obviously mortgage rates right now are at all-time lows. I mean, literally the lowest rates they've ever been. So usually, now here's the other thing that you have to factor in on a line of credit. Normally those are done in what we call second lien position. So if you guys are familiar with how title works, one of the reasons we have to clear, I'm sure you guys are realtors, you have to clear title, or you have to, we have to wait for title to come in. What we're really doing, and what title insurance is really doing, is ensuring that this first mortgage we're doing here is in first position on title, which means that there are no liens in front of us. And in the event of a foreclosure, we get paid back first, right? Now, a line of credit would be in second lien position. So there, if you were to do, let's say, a home equity loan that isn't attached to prime and at higher loan to values, in the event of a foreclosure, those companies almost never get their money back because we get every dollar that we're owed, all of the interest on our money, all of the penalties for missing the monthly payments, the legal fees of going to court. We get all of that back before the company in second lien position starts to get anything back. And so that's why fixed rate mortgage, second mortgages are often at much higher rates than primary mortgages because, again, in the event of a foreclosure, they're much less likely to get their money back. But that was a really good question. I appreciate it. Do we have any other questions? Courtney, I think you're muted if you're talking.
We have two more questions that came in. One from Emily Turpak. She asked, if someone has to pay $3,250 for every $100,000, do they pay that $3,250 over the course of a year?
So that's a great question, and we're going to get to how that works in a second. That money is essentially due at closing. Now, on a refinance, oftentimes we will roll that money into the loan. So not only are you actually paying that money up front, but you're also financing it over 30 years and paying a whole bunch of interest on it. But that money is due essentially at closing. Now, the reason why you say, hey, I know I've done a bunch of loans for my clients where they had bad credit, but they didn't pay any of these points. Yes. The other option here, which we're going to go into in a minute, is if you give somebody a higher interest rate, the rebate that we get from our investors or from Fannie Mae and Freddie Mac for charging you a higher interest rate, we can apply to these penalties. So one of the things that we're going to get into when I get into the pricing models is interest rates and closing costs have an inverse relationship. You can always or usually cover most or all of these extra closing costs simply by giving somebody a rate that is higher, because when I deliver that rate to my investor, they're willing to pay more for it, and I'm going to cover these costs with that money. So that in that case, you end up paying for it over 30 years because you're essentially accepting a higher interest rate for it to cover these upfront costs. So it is actually real cost. And if you were willing to bring that money to closing, you would get the exact same rate as somebody in a perfect situation. But what most often happens is we give you a higher interest rate to cover these extra penalties or costs associated with these extra risk factors. So I hope that makes sense. And if it doesn't, please keep asking. These are great questions. One more
we
question.
had one more question
Emily, right?
too.
Thank you, Emily.
And this one is from Art. He asked, does it matter how much cash you are looking to take from the loan?
So generally, no. Most of the time, if you're taking more than $2,000, it's cash out. And up to either 250 or 350,000 cash in hand, depending on the investor, or our own guidelines, we would just basically say yes or no up to a certain amount. But generally, any amount in between there, it doesn't matter exactly how much of it is cash. If it's cash out, $2,001 is considered cash out, and then so is everything else above that. That's a great question.
Cool. I think those are all of our questions that we have right now.
Thank you guys so much. Thank you, Art, for bringing that up. I appreciate it. So what I want to do now, and I'm gonna take you through one or two more quick charts here, and you're gonna see some other things that are hitting the pricing that we'll see, and some other compounding factors. And then I'm actually going to show you some actual pricing scenarios, and we'll be able to go over and you'll be able to see this real live working. And I'm also going to talk to you about how much money mortgage companies actually make on these loans. Get to the fun part. So if you are doing an investment property, regardless of the loan to value, anything up to 75% loan to value, your pricing is automatically $2,125 per 100,000 borrowed worse than somebody borrowing money on their primary residence or a second home. Now, one of the greatest areas of mortgage fraud, which you do not want to help your clients participate in, is trying to say that investment properties are second homes. Because a second home has none of these hits, and an investment property has these hits. And here's the deal. If you intend to rent that home out, it is an investment property. If you lie about it, it could come back to bite you and us. So it's very important that we're being honest about what that means. If you are buying a second home, if you live in Mount Pleasant, South Carolina, which is a town next to the beach, and then you're buying your second home at the beach, that's not going to fly. You can't qualify with a second home 3 miles from your primary residence. It doesn't make sense. It may even be true. It doesn't make sense to the people that are doing the underwriting. So traditionally, if you're doing an investment property, and you're much more likely to get called out for this type of mortgage fraud if your investment property happens to be in an area where lots of people, or your second home, I'm sorry, let me say this backwards. If you're buying a second home in a place that no one ever goes on vacation, that's probably a hard stretch, right? Usually, you know what I'm saying? If you're trying to say like my second home is in the middle of the Bronx, are you going there on vacation? Probably not. That's a hard swing. A hard thing to pull off with an underwriter. So not that I don't love the Bronx, but I'm just saying I'm not spending my vacations there. So investment property versus second home, you can see between 75 and 80 LTV, there's even a bigger hit for being an investment property. These are considered very risky, right? Because we're relying on the rent from somebody that we don't know or we're not evaluating as a mortgage company to help you pay these payments. A house that's a 2-unit home, there's $1,000 for every $100,000 penalty. 3 to 4 units is also that same $1,000. This used to be more. It's been reduced. You can see that mortgage companies, because we make money on the amount of money we lend, and every loan is the same amount of work, whether it's a $400,000 loan or a $50,000 loan, we make more money for $50,000 loans. And then here's another one that many people don't know about. You actually get better pricing on your mortgage, $250 for every $100,000 borrowed, if you're willing to include your taxes and insurance in your mortgage payment. There's actually a penalty for waiving your escrows or not escrowing of $250 per $100,000 borrowed. Something else to keep in mind. There are also penalties for condos over 75% loan to value and greater than 15-year terms, and you see some other factors down there. So what I want to do now is I want to take you guys to an actual pricing scenario. And I want you guys to see this. This is the actual tool that we use to price loans. I'm going to show you the raw pricing from our investors or from Fannie Mae and Freddie Mac. And you can see how we make these decisions and how it impacts each individual person. So we're going to start here with what I would call vanilla scenario. Can you guys all see that, or should I make it bigger? Better? All right, cool. So you can see here, we have a first mortgage purchase, $300,000 purchase price, $240,000 loan amount, 80% loan to value. We're looking at a 30-year fixed, conforming conventional agency loan, Fannie Freddie. Target rate we're shooting for is 3.25%. And that the rest of this we'll kind of get into later. Oh, it's going to make me log in again. All right. So this is just the borrower's information, nothing to look at here. This is our finance screen. Credit score is 740. Remember, we showed you everything above 740 is considered perfect by lending standards. And it's not a first-time home buyer, but the borrower does have a 12-month mortgage history, and the borrower does have a 12-month mortgage history. We're doing this loan in New Jersey. Usually zip code and county does not impact pricing, but state definitely can. But it's usually pretty insignificant, a quarter point or less difference between different states most of the time. So here's our pricing, and what you're going to see here is this is our pricing and our different options. This is direct from Freddie Mac. This is two different ways of locking the loan, but they're both Freddie Mac. This is direct to Fannie Mae. And then you'll see we have US Bank is one of our investors, Wells Fargo, Planet Home Lending, North Point, and we have some others, but these are the ones that are offering the best pricing at this particular scenario. So again, as you see here, purchase, $300,000, $240,000 loan amount, 740 credit score. By giving somebody a 3.25 rate today, my rebate from Freddie Mac when I sell them the loan is 3.79 points, or in this case, on a $240,000 loan, $9,096 that they're going to pay me to deliver this loan today at 3.25. My payment on that $240,000 loan is $1,044. And if you see here in my details of pricing, the only hit is this half a point right here for credit score and loan to value being 80%. Now, if I go back and I show you in my chart, you'll see this correlates right to the chart. We have a perfect credit score at 80% loan to value. Here's my half a point. And then you're seeing that in the chart here. Here's that half a point. So if in a perfect scenario, Freddie Mac would be willing to pay me 4.29 points. For this particular loan, 3.79 points. Who's with me? Cool. So here's what I want to show you guys. So this is a generic, pretty perfect scenario for somebody, a standard borrower with good credit. Now let's see what happens if we have this exact same situation, but my borrower has a 670 credit.
May I have a question?
Sure. What's going on, Barry?
I noticed the top of the chart had a lower rate. I know the pricing wasn't comparable, but why wouldn't your client want to go with the lower interest rate?
That's a great question. I'm going to get to that in 1 second. They can, by the way. It just depends, by the way, on what I want to make as a mortgage company or what I'm willing to do the loan at. Okay, so we'll talk about what that means in a minute. And I'll explain to you how we establish our margins as a mortgage company. I'm interested to see what you guys think, by the way, in terms of how much you think these mortgage companies make on these loans, but we'll go over all of this in general. So we have a 670 credit score here, but thank you. I promise I'll get to that. So we saw what it is at 740. Now let's see what happens at 670. Same scenario. Now my 3.25 rebate to the mortgage company is only $36.96. So remember, we were over $9,000. So that's a $5,400 difference in the amount of money I make as a mortgage company, lending this rate at 3.25 on this loan, this size loan, versus if it's at 740 credit score. That money, by the way, as a mortgage company, we don't give that up as charity. That gets charged to your borrower, or they have to go with a higher interest rate. So what normally happens, especially on a purchase where somebody doesn't have another $5,000 to bring, is now I have to search on my chart for a rate that's going to pay me that $9,000. Even at 4%, so I went from 3.25 to 4%, I'm still not getting all the way back to my $9,000. I'd have to charge this borrower $550 more. So they have a 740 credit score, they're getting 3.25 with no costs. At 4%, they're still having to pay me $600. And if they have a credit score that's 670 versus 740. The difference in monthly payments over the next 30 years is $102 a month. So the difference between having a 670 credit score and a 740 credit score is $36,000 in interest over the life of the loan and $600 up front. That's why it makes sense, by the way, when someone starts searching to buy a home, for them to work with a mortgage company that is willing to work with them to get their credit score up. If I can do a couple of rapid rescores over the course of a 60-day buying process and get somebody to go from 670 to 740, I might be able to save them $36,000 in interest over the life of their loan. This is where having a lender who's willing to do the extra work and knows this stuff makes a huge difference, okay? So again, this is just a regular 20% down scenario, nothing special. The only thing we changed was credit score, and it's a $36,000 difference in interest over the life of the loan. So you're getting 3.25% and 4%. Remember, this is not some terrible credit score. There are a lot of people who fit into this 670 category. So now let's look at this. What happens if I go to 639? Still not terrible. Where's my $9,000 number? In order for me to even get close, well, it depends. And you can see here, at some of these higher rates, they don't offer that much bigger rebates. The rebate kind of changes. So really, in almost all of these scenarios, it's going to make sense for your borrower to be bringing money to closing or paying extra money. But you can see here, the penalties keep getting steeper and steeper. And you know, if let's say someone doesn't have any extra money to bring and they have to go with this 4.875 rate here, now we're talking about a difference of $225 a month. You add that up over 30 years. Anybody want to take a guess? It's like $90,000 in interest. $90,000 difference between 639 and 740. Okay? So you can see how much of a difference this makes. And by the way, if you have a 639 credit score, it usually will make sense to go to 640 or 660 and do some things with your credit that we can improve your credit to get you better pricing. So let's go back and look at some other scenarios real quick. So we go back to finances. Let's say, well, first of all, let's say let's go back to 740. I want to show you what I showed you guys with the 15-year pricing. So we're gonna do the same. Remember, anybody? What was the mortgage payment? It was about $1,000. It was between $1,000 and $1,200 a month in mortgage payments on the 30-year, depending on what rate we gave you, right? So in this same scenario, let's say we go with the 15-year. Let's see what our pricing looks like and what our payments look like. By the way, I'm still at the 639 credit score, right? With a 639 credit score, okay, in the same scenario, I need to make my $9,000 number. Remember, there are no hits to 15-year pricing because of the credit score. So here, I can make, let's say we go down to 2.75% on the 15-year pricing. My total payments are $1,629. So in the scenario that I just gave you where someone has a 639 credit score, the payments to go from a 30-year to a 15-year are only about $350 a month difference. All of that $350 they're paying each month is going to themselves. They're paying it to the principal on the house. So they can find that extra $350 a month. They're paying that money to themselves, and they're drastically reducing the amount of interest they're paying over the life of the loan. And I can do some really cool scenarios and some charts to show you guys for individual scenarios with your borrowers or so many of the loan officers here to kind of show you. I mean, you're talking about saving over $100,000 in interest over the life of the loan and paying it off 15 years faster if they can afford that slightly higher monthly payment. Now, what you'll see here is at the 2.875 number, I'm making my $94.15. As you'll see here, even if I have perfect 800 credit, I don't know if you guys, credit scores go from 350 to 850. National average is somewhere in the 720 range. And so let's say I have 800 credit. As you'll see here on the 15-year program, there's absolutely no difference. 639 FICO, 800 credit score. All right. So let's talk about how we determine what our margins are as a mortgage company. How much money do you think mortgage companies make as a percentage on these loans based on what you're seeing here? Anybody want to take a stab at it who's not in the mortgage industry or working for Princeton? No guesses? So most mortgage companies are priced out at around 400 basis points total. Now, a lot of that is now roughly half of that money ends up going to loan officer compensation and marketing. But so the company actually ends up taking home about 200 to pay their operational costs, but about 400 basis points is the average industry-wide for what mortgage companies are making on a conventional loan like this. So as you can see here, on a 15-year fixed right now, in this scenario, most mortgage companies are probably pricing today at 2.875. Now that's if they're one of the mortgage companies that's fortunate enough to be delivering right now directly to Fannie Mae and Freddie Mac. In normal times, that doesn't actually matter that much. Most of our other investors are priced the same or better than Fannie Mae and Freddie Mac. But since the coronavirus hit, the other investors have really backed off. So in other words, if we would have done this same presentation 3 months ago, Fannie Mae and Freddie Mac would not have been at the top of my chart. Somebody else would have been here. What you're seeing now is US Bank, who's my #1 investor today, at 3.25, is paying almost 100 basis points less than Freddie Mac. So if you're dealing with a mortgage company that doesn't sell directly to Fannie Mae and Freddie Mac, today, your borrower is paying 1 point more to go with them, even if their company is making the same amount of money as our company, or as a company that's selling direct to Fannie Mae and Freddie Mac. So today, it's a huge difference going with a mortgage company that sells direct to Fannie and Freddie versus a company that doesn't, because the aggregators, as they're called, which is the Wells Fargo's, US Bank, Bayview, you see down here, they are no longer offering competitive pricing because the servicing has become risky because of the forbearance things we talked about in our last session. So normally you have all these aggregators competing for the right to buy this loan and offering you really good pricing. Now they're basically saying, let Fannie Mae and Freddie Mac have it. Make sense to everybody? Who's still with me? Am I losing people?
Mark, we've had a couple of questions come in that I would love for us to answer.
Let's do it.
First one, again from Art, which I think is a great question. What is a basis point?
1 basis point or 100 basis points equals 1% of the loan amount. So 100 basis points equals 1 point. So on a $100,000 loan, 1 basis point equals $10. 100 basis points equals $1,000 for every 100,000. I know it's a lot of zeros and moving decimal points for the math, but essentially 100 basis points is 1%. It's a great question. Thank you. That's something I slip in and out of that vernacular.
Yeah. A couple of other questions. How would it vary if the loan was done with Wells rather than with you?
Directly or like?
I think the question is if the loan was done directly with Wells versus us and then sending it to Wells as the investor.
Right. So that's a good question. And so there's no simple and easy answer for this, but here's, I guess, the best way I can describe it. Remember I just told you that half of the revenue a mortgage company makes goes to sales and marketing? Well, what Wells Fargo is doing is they're saying for a good chunk of the mortgages that we want, that we're going to take on, we don't want to have to deal with all the costs and energy and effort it takes to have a sales team, pay them, have a marketing team and pay them. We would rather let another mortgage company do all of that stuff on the upfront and then just buy that mortgage after the fact. And so that's what all of these companies are doing. These companies, by the way, like Wells Fargo obviously does originate their own loans. Bayview and North Point, I'm not even sure they do. They may only buy on the secondary market, but essentially you can have a mortgage company that services mortgages without ever having a retail sales team that sells mortgages to individual clients. And you can get into the game by basically saying, we will pay for that mortgage from you. You guys handle the sales and marketing part of it. We'll handle the rest, the operational part. Now, this is even a little more complicated because we actually handle, even when we're selling to these investors, we still handle most of the operational part of it. We still underwrite the loan, process the loan, and close the loan. So they're coming in really late at the very end and just making sure that we did it correctly and then buying that loan from us and collecting those payments from that borrower moving forward. And so today, for instance, Wells Fargo is saying for the right to collect your borrower's mortgage payments at 3.25%, we are willing to pay you $9,000 on this loan. right? And so that's how that works. Now, what we talked about last week that might have been a little high level, if you're here 2 weeks ago when we had this, was this is less than normal right now because there's two reasons. But one is when they figure out this number that they're willing to pay, this 9,000, their bet is that they're on average going to be able to collect payments from that borrower for 7 years. That used to be the calculation or how we valued these servicing rights. Well, a lot of the loans these guys bought over the last 3 years, they thought they were going to have for 7 years. They all just refinanced. So all that money they laid out for the right to buy these loans and service these loans, they're just out on that, right? And so that's where a lot of that pain is coming in there in a lot of these mortgage companies, because this is all a bet on 7 years of payments. And if you're only collecting 1 year or 2 years or 3 years, 3 years is almost the break-even point. And if it was at 4 years of profitability, you're seeing these companies get burned on this stuff because the rates unexpectedly dropped. Were there other questions, Courtney?
There was one more question. Why are certain lower rates offering higher rebates?
It's a great question. So you won't actually see that, I don't think, at all on the direct to Fannie Mae and Freddie Mac, right? Because we're selling direct there and there's no securitization pools. But here's where it gets kind of complicated. So, and there's a bunch of areas, I guess, where it gets kind of complicated. But here's one of them. So if I'm Wells Fargo, and you see here, it's not the same amount. So like, for instance, right here, they're selling 3.5 is a better rebate than 3.625. The reason for this is Wells is selling their mortgages to securitizations in bulk. And what this is telling me right now is either they don't actually have a 3.625 securitization, they're just jamming those into their 3.5 coupon, or they have one, but maybe the 3.6 securitization is almost full, but there's the 3.5 is one they need to fill. So in other words, because their overall huge mortgage securitization bets are built on being able to deliver a certain amount of mortgages at a certain rate, there are sometimes it makes more sense for them to incentivize people to send them loans at a specific rate than it does another specific rate. Because they want to be able to deliver exactly 1,000 of these loans at 3.5%, and maybe they're falling short on the time period. So say, okay, man, we really got to get more of these 3.5% loans. How do we do that? Well, we offer everybody a little extra money at 3.5, and then people will, those 3.5 loans will be sold to Wells instead of to Bayview or North Point or US Bank. So they're bidding to fill those securitization pools at certain rates. With FHA and VA, you'll almost always find that their rates are on the quarters or the halves, because almost nobody offers securitization for FHA and VA, or Ginnie Mae, what we call loans, on the eighths. So here's where you'll see like every eighth is available. On an FHA loan, if you look, like 2.75 will almost always pay better than 2.875. 3% pays better than 3.25, because we're filling securitization pools on the quarters and halves. There's just not enough volume to do those on every single eighth, if that makes sense. So that's pretty high level stuff, and if I'm losing people, I'm sorry, but
Russell, the same person who asked the initial question, just as a follow-up, said, so essentially they are funneling buyers to the loans they deem more desirable.
Yes, and that desirability is strictly based on bulk buying. So in other words, let's hedge fund X says I'm willing to pay more if you give me 1,000 of these loans than buying 1,000 individually, but you have to be able to deliver 1,000 to me by this date. And so they're using pricing incentives to be able to fill that securitization by a certain time. Cool questions, guys. This is awesome. And so, are there any other questions to go over, or are we good so far for that?
We're good so far.
So here's what I want to show you guys I want to show you guys some cash out refi scenarios so you can see how the differences work out there. And again, I know you guys, by the way, are mostly realtors, so maybe this doesn't impact you directly. But one of the coolest things you can do as a realtor right now is tell your consumers who bought a house a year or 2 years ago that now is a good time to refinance. It's a perfect phone call for you to make to touch base with your client base, where you can provide extra value to them. It also doesn't cost you anything, but it's a reason to call. And it's also a reason for you then, while you're calling, to see if they know anybody who's looking to move or get more information about what their home desires are looking like, right? And so I often have such realtors who are looking for a reason to touch base with their previous clients. A perfect reason right now is to say, hey, if you're not refinancing, now's a good time. And by the way, if you pass those people to your favorite loan officer, your favorite loan officer is going to return the favor in a bunch of different ways. So Let's look at a cash out scenario. So we'll cash out 80% loan to value here. We do have to put in the amount of cash, but again, as I said before, it doesn't really matter if it's 2,000 or 200,000. It's going to do the same thing. And we're gonna keep our credit score at 740. And you'll see here on our 30-year fixed through Freddie Mac, 3.25, and this is for a 30-day lock, as you can see here. Each lock, there's another thing. Let's take a quick look at this. So here's for a 30-day lock, it's paying 102.9. If we do a 45-day lock, it's 102.7. So it's a difference of, in this case, $500 almost to do a 45-day lock as opposed to a 30-day lock. So when people are like, should I float? Should I lock? Where's the market going? That's why all this stuff becomes really important, because if you're locking for longer periods of time, it does get more expensive. Okay. So let's go back to the 30-day lock. 3.25 is paying 102.915. Cash out to 80 LTV. And you can see here the hits we showed you in the chart. So that half a point hit is the same. That's still in there. Now we have an additional hit for the cash out. So if we go back and look just really quickly at that chart, this is our cash out chart. We're 80% loan to value with a 740 credit score. Here's that 0.875 hit. So you can see that being built in. And so again, the difference between doing a purchase or a rate and term refi versus a cash out for this loan is 0.875%. Make sense? So $875 per 100,000 borrowed, right? Now let's take a look at a lower credit score. Say we go even just to 690. So by the way, remember, I need to make 400 basis points, right? If I'm the mortgage company. So I'm actually here without paying points, right? So in other words, we talk about points, right? So today, here's another thing, right? So let's say I want to give this person the 3.25. I would have to charge them 3.2 points up front, and I can roll those into the loan in order to get this 3.25. Or I may go to 3.625 here and charge 2.1 points instead of 3.3. But we have to get to 4 total one way or another. That's how the mortgage company is going to look at that pricing. And if you see here, we click on the details. We have a 1.75% hit for just going to 80 LTV at 690, and another 1.75 hit for going cash out at 80 LTV with a 690. So a total is a 3.5 point difference. Remember, so a purchase here with perfect credit, 3.25 on a 30-year fix is where you're at. Cash out refinance at the same credit score, you're charging 3.2 points, or in this case, $7,200 in costs to get that same interest rate at this amount. Questions about any of that? I do have a couple other things I want to show you.
We did have one question about credit scores. This says, so it appears that 740 is the good credit number. Why does my Credit Karma say 760 and a mortgage company could run 700?
Why is there a difference between what Credit Karma is reporting and what your mortgage company is reporting?
Yes.
Yeah, so your mortgage credit score is different than all other credit scores. What you get from Credit Karma and what you get at the car dealership are usually going to be exactly the same. Mortgage companies use their own credit scoring system, and it's always going to be slightly worse than what you're getting in those other scenarios. It's just the way mortgage companies pull and score credit, and it's all the same everywhere you go on that. They are looking at the exact same factors, and we are still taking the middle of your 3 credit bureaus. But yes, so there are, and by the way, some of the, like Wells Fargo actually will give us an extra 1/4 point rebate over 760. So individual investors can decide that they want to incentivize, have a different chart essentially, because they want to buy a certain pool of loans. The chart that I'm showing you and that we're working off of here is the government one, direct to Fannie and Freddie. It's the standard. But so there are certain investors, or for instance, on jumbo loans, having a difference between a 740 and a 760 might matter. But for the regular conventional Fannie Mae and Freddie Mac loans, anything over 740 is considered perfect, and anything under 60% loan to value is considered perfect. There are other, in jumbo mortgages where companies are making their own rules, sometimes being the difference between 50 LTV and 60 LTV can make a difference in what you can do in pricing. But for these, these are the kind of the standards for these government programs. This is good. What time is it? Oh, we're almost done. All right. So I want to show you guys one other quick thing. So let's say we get back to somebody with a perfect credit score. We're 20% down, 80 LTV. One of the things I want to show you guys is if we're doing, let's say we're doing this as a 2-family investment property. You can see what the differences are here. Oh, it's not going to let me do it. Let's see. This is what happens, by the way, if they don't qualify. It says cash out refinance is not permitted. Yes, I wanted to do a purchase, so it's smarter than me. Must be a first-time home buyer. All right. Let's try this. Yeah, so it'd be at 75 LTV. Cool. So you can see where it's at 70. That's basically what they're saying is if you want to buy a 2-family investment property, you need to put 25% down. That's what your loan officer is doing when they come back to you and they go, oh, I screwed up. They have to put 25% down. That's the process they're going through. So as you can see here are the hits that we talked about being built in. So again, our perfect scenario never changes. If you've seen every time 3.25 and a 30-year fixed, the start rate's always this. That has not changed since we started the presentation. But we have a 1/4 point hit for FICO in this scenario because we lowered it from 80 LTV to 75 LTV. We have a 2.125 hit for investment property and a 1 point hit for a 2-family. And so again, I need to get to 104 as a mortgage company. So in this scenario, I'm going to have to charge 3.1 points to get to 3.25, or as we showed you before, go with a higher interest rate. Let's say in this case, 4% and charge 1.1 points to get to the 400 basis points. And so this chart is always available. So when your borrowers say, I want a lower interest rate, they have to know that there's more closing costs that's associated with that. Conversely, if they say, I don't want to pay any closing costs, they're definitely giving themselves a higher interest rate. And so this is that choice that they're making between those two things. So that really concludes a lot of the presentation for me. I will show you as we go. I will send this out to you guys. And as you'll see here, we have some different pricing adjustments for when we're doing a second mortgage or a home equity line of credit as part of the purchase transaction. There's some additional hits to pricing. There's FHA has some different mortgage insurance amounts depending on loan to value and the loan amount. They charge a different amount of monthly mortgage insurance for FHA loans. One thing about FHA loans, though, guys, is that the Ginnie Mae securitization pool does not pay differently for cash out or lower credit scores. All FHA loans are essentially starting at the pricing being the same. Any difference in pricing for credit scores or for LTV on FHA is being built in by the mortgage company to take on that risk. So, but that money is actually going in their pocket, not to the securitization pool. FHA basically says everybody's created equal, either you qualify or you don't. Then the mortgage companies are the ones pricing in risk. As you can see here, the securitization pools on the conventional side are the ones pricing in the risk. That extra money is not coming to us. I don't make any more money if you have good credit or bad credit on these conventional deals. The securitization pool does. For FHA and VA, it's different. If we have worse pricing for lower credit, it's because the mortgage company decided they wanted to make more money. So I just want to touch base on that quickly. And then we have the terms here that I'll send out to you guys that can kind of fill in any blanks that we had during the presentation. Do you have any other questions? I would love to answer some more questions here while we have a couple of minutes left. You guys can shout them out. You can unmute. You can talk to me.
If you have any questions, you can unmute, or you can throw them up in the chat and I can get them out to Mark.
So while anybody thinks of a question, one thing I'll say is it would mean the world to me if you guys would give us honest and candid feedback about the presentation. You can email me or call me, tell me things you think we could do better. You're not going to hurt my feelings by telling me all the things I did wrong. You'd be doing me a favor. You'd be helping me. We want to be world class at this and we want to continue to get better. So please do us the favor of telling us all the things that we should be doing better and could be doing better with these presentations. And also, if you think of any other questions outside of today or this, you can always reach out to me. My contact information is here and on my LinkedIn and everywhere. I'm very easy to find. This is my personal cell phone number. I'm pretty much attached to that thing. You can ask my wife. She would prefer I was less attached to it. Yeah, we would love to answer any questions that might pop up along the way. But any questions about any sort of pricing scenarios or individual things you've run into that maybe we didn't cover or aren't explained, or that we can fill in the blanks for you on?
Hi, can you hear me?
I can, Elizabeth. Thank you. How are you?
I'm good. I just wanted to say thank you very much for the information. I'm sure my head will explode with questions in the future, but I don't know how to say this. I enjoyed the presentation. Thank you.
Wow, thank you. That means so much to me, honestly. You know, we do want it. We want it to be informative, but we'd also like it not to sound like I'm talking at you guys for the whole time. So I try to make it interactive and engaging and share the cool parts.
Thank you.
Any other questions at all that I can answer for you guys? All right, guys. Well, thank you so much, everybody, for coming. Honestly, spending an hour of your very busy day with me means the world to me. We sincerely appreciate it. And again, if there's anything else we can ever do for you here, please don't hesitate to reach out. Otherwise, we hope to do another one of these in 2 weeks, and we'll send out some potential topics for you. Thanks so much. Have a great day.
One quick thing, guys. You all will receive an email tomorrow from us that has a recording of the presentation, and it also has the presentation deck in there so that you can download it and save it and reference it as needed. We'll also include a either if you want to reply to the email and just let us know if there's any feedback that you have for us on this, or any other topics that you would like covered. It was really helpful for us to hear your responses that this was a topic that you really were interested in. So any other suggestions that you guys have would be really appreciated.
Awesome. Thank you so much, everybody. Have a great day.
Bye.
Thank you.